Is that it? Everyone's in? Oh, better wait for Bruce. Okay. Well, I hope you all had a good time catching up, doing a bit of networking there. Certainly looked like it. So this is our second half of our forum, and we have a couple of presenters, John McKillop and Danny Thomas, to present. So I'd like to just introduce John McKillop, Managing Director of AgCAP Proprietary Limited. He's worked in the agribusiness sector for a considerable amount of years, and ranging from not only family farming business, but also to quite large agricultural companies across the world, as you would have read in his bio. John's also a member of our CSRA committee, so he certainly puts quite a lot of valuable input into that group, such as these forums too. So I won't take up any more time, but John's going to give us a company perspective on foreign investment for us. So thank you, John.
Great. Thanks, Yasmin, and thank you, Simon, for the invitation to speak. One of the good things about going third is I get to listen to Peter talk first, and I can rebut a lot of what he said. I think it'd be a dull world if we all agreed. So Peter and I had many spars over this debate over the years, but always in a very friendly nature. But look, one thing I do agree is that ASX-listed corporates don't work in agriculture. I think that's been proven. If you look at AACO, it trades below net tangible assets. Prime Ag, well, it only lasted 3 or 4 years and never traded above net tangible assets. So I think there is a problem there, because under the accounting standards as they are at the moment, you cannot book your capital gain, and quite rightly so, which means that you're only reporting on half of the story within the investment in agriculture, which is the operating returns, which tend to be not only fluctuating but generally low. So I think, yeah, one thing we do agree is that publicly listed isn't a good vehicle for corporate investment in agriculture. One thing I don't agree is that consolidation is necessarily the fault of foreign investment. And I think people often confuse those two, that sure, foreign investment does assist with consolidation of farms, but consolidation is happening anyway. You know, as Peter said, he's aggregated 4 over his own time. And really, if you look back in history, what we're really doing now is re-aggregating what we disaggregated after the post-World War II period with the soldier settlement scheme. And if you look back now, you'd say that was a flawed scheme. Whilst it did help a lot of people get into agriculture, it left a lot of 640-acre blocks scattered around the countryside, which were not viable, which are subject to land degradation, and ultimately now being reconsolidated back again. So I think it's not a foreign investment issue, it's just a natural cycle of re-aggregation again. I always take a little bit of exception when people say that foreign investors aren't subject to tax and aren't subject to levies. Certainly levies are, certainly compulsory levies. You know, I'm on the board of MLA, I'm on the board of Dairy Australia. It doesn't matter, we don't care if that's foreign owned, family owned, or whatever other structure. If you sell a litre of milk, you pay a levy. If you sell an animal, you pay a levy. Tax, well, there's some exemptions there around whether they're a registered charity or not, so there are some tax exemptions there. The main issue that people seem to focus on is either the thin capitalisation rules, which is not just an agricultural issue, it's an issue around any investment in Australia. So basically what that rule means is that you can't invest in Australia with about 5% capital and the rest is 95% debt, and transfer all the profits back out in interest payments and not leave anything back in the company for tax to be paid in Australia. The other one is what they call market transfer rules, and again they're fairly tightly regulated. And so basically what that rule means is that you can't sell wheat over to a foreign country at $100 when it has a market value here in Australia of $200. And people say you can get around that. If any market is transparent, it's agriculture. You can look up any day and see what the price of wheat is, what the price of soybeans is, how much a carton of rumps will make out of a Queensland abattoir. It's a very transparent market. It would be the hardest market to do a market transfer manipulation in. The other one is that, I'm back on to Peter. I'm still going on Peter's here. I'll be 20 minutes just on this one. The thought that foreign investors and consolidation, is bad for the community. it's not a foreign issue, it's a consolidation issue, but at the end of the day, we employ family operators. You know, we don't employ machines, we don't employ a bunch of bankers from the skies in Sydney or Melbourne. We employ family farms, and those families turn up to the football and they buy the tickets. And they not only buy the tickets, they actually have enough capital to then go and reinvest back into the community to make contributions to the local football team. In a previous life, when I ran Clyde Agriculture, we contributed $30,000 a year to each of the regions we operated in. We operated in 4 regions, and that typically went to the hospital, to the aged care facilities, etc. Now that was their major source of income in both Walker, Coonamble, Burke were those donations that were made by the corporate, and in that case the foreign-owned corporate. Couple more points from Peter. Lies, damned lies, and statistics, I say. The top 20% of producers do not consistently make 20% in a family operation. Now, what's not understood a lot on those ABARES data is, unless you go to the actual source of that data, it's not the same people in that top 20% each year. So you can have the top 20% of the group surveyed this year made 12%. The year before made 12%, but they may or may not contain the same people in each one. So what's more important is, do you follow a group of the top 20% over a 10-year period and what's their average returns? And that is significantly less than 12%. And I think in actual fact, if you look at the home sacket benchmarks and the AgriPath benchmarks, corporate are pretty much up there in a lot of cases in that top 20%. But it's important to understand that distinction, that the ABARES data is not a consistent cohort. It's a different group each year. I was really pleased to see that Peter put a picture of Cubby Station up there with all those cotton pickers, because I'm on the board of that one, and it is 80% foreign-owned. We've just spent another $20-odd million buying the cotton gin, and we've just spent another $5 million fitting it out to increase its capacity. And there's no Chinese investors. There's no Chinese investors working on a paid basis. There are Chinese people up there, but we're not actually paying them. They're actually free labour at this point. So. Yeah, so I don't think it's, despite the concerns that possibly Barnaby, Joyce and a whole lot of others had that when Shandong Rui came into Cubby, that it was going to be inundated with Chinese workers picking cotton manually. I'm going to assure you there were 24 cotton pickers up there and they completed that harvest in 21 days. Okay, now the real purpose I was talking today is going to go through a bit of Australia's foreign investment policy, talk about some of the levels of foreign investment in Australian farmlands, and then talk about the past, present and future of investment in ag. I've got to click that, haven't I? I think I'm wondering for someone. Okay. I think, as Philippa said, there is no national registration at this stage for foreign ownership in Australia. Queensland is the only state that actually has their a state-based one. It's one of the things, and I've got to say, Peter and I actually did agree on this one as well. We pushed for a national register to be established. And part of the reason is so that we can actually remove some of the debate and some of the rhetoric from the discussion and actually have a discussion based on fact. It sounds simple. If you have a foreign investor, then you need to put a registry or register that interest on the national database. The problem is that it's never that simple, because if you take Macquarie, now Macquarie Pastoral Fund is an Australian domiciled fund. 95% or maybe even more of their investors are foreign. So is that a foreign-owned entity, or is it a foreign-invested entity? I mean, at what point do you categorise that? If you went up to Queensland and said, it's like Cape Consolidated Pastoral Company that was bought out by Terra Firma, most of that land they bought, if not all of it, is actually pastoral lease. So is that an ownership, or is that simply a lease? Because in most of the parts of Queensland, similar to what Western New South Wales is, Western Lands lease, most of Queensland is still under pastoral lease. In fact, many leases prevent companies from owning it. So one of the issues is that we don't have a lot of facts about it. We have a lot of emotion, we have a lot of hearsay, but we don't actually have a lot of facts. So I think I would certainly be a strong supporter of establishing the national database. We've just got to work out how we do it. The closest we have is that ABS conducted a survey in December 2010, and based on that, 136,000 agricultural businesses in Australia. 1% are partly or wholly owned by foreign entities. Now, 1% of the businesses, 11.3% of the total land. 98% of that ownership was within sheep, cattle and grain. Again, it's one of the issues if you go back to the establishment of the database. The database, even Queensland at the moment, just is on hectares. Now, if you own 1 million acres up in the Gulf of Carpentaria or out in the Barkly, it's a very different story to owning 10,000 acres in the Western Districts of Victoria. What we actually need to look at within that database is perhaps the value of that land or the relative value of that land, not just the actual hectares, because they're really misleading. As you can see, 1% of businesses with 11% of the land mass. It doesn't really tell you the full story. ABS further estimate there's $507 billion of direct foreign investment in Australia. Philippa mentioned it was less than 1% globally. It's 1.12% of that $507 million is actually invested in agriculture in Australia. It's a relatively small amount of the overall foreign investment in Australia. Now the rules, probably everyone knows these, but I'll just go through them quickly. The current threshold before you need to go to FIRB is 248 million. The exception to that is the US, which has a 1 billion and 78 million threshold. You're wondering why they're exact, because they're indexed every year. If you're an SOE, Sovereign Wealth Fund, then the threshold is zero. So $1 invested into agriculture needs to go to FIRB. So ones like Assad, everything that Assad buys in Australia needs to go through FIRB for approval. I've got to say that their process is very slick. They have it down pat. They've done, I think, over 100 transactions now. They're very good at it. And I don't think too many people now, despite the fear when Assad first started coming in here, are seeing them as a major threat. The coalition policy, thanks to Peter, has reduced this down to 15 million. Now, if 99.9% of FIRB applications are approved, lowering the threshold from 15 million, from 248 to 15 to $1 really makes no difference, other than to the lawyers who make the money out of going through that process. The issue is, what is the test that you apply to that? If you don't change the test, then all you're doing is ticking more boxes and making more work for everyone. So it comes down to that issue of what is in the national interest in looking at foreign investment. Just trying to go through a bit of a pathway. So who needs to apply? Foreign investment. Foreign governments or related entities must go through it if they take a direct investment or greater than 10%, and always in potentially sensitive industries. Private foreign investors, as I said, 248 million is direct investment or greater than 15% where they seek to seek control of that entity, and always in real estate. So what's probably not understood is that every unit, house that is purchased by a foreign individual must go through FIRB, and you can imagine that's such a rubber stamp because they're just churning them through. You almost wonder why they bother going through the process for it. How do we compare to other foreign businesses in terms of how restrictive we are around foreign investment? We're up there of the OECD countries. We're in the top 7 of the most difficult for foreign investors to invest in this space in farmland. Globally, we're sort of up there in the I suppose the top quartile. You can't read that graph, but as we talked about before, the most restrictive are in the countries that Philippa talked about in particular, and the most difficult: China, Saudi Arabia, Indonesia, India, Japan, New Zealand. Oh, sorry, I keep forgetting to do that. I'm just doing it on my one, not forgetting of it. Not linked. We need technology here, I think, Yasmin. So that's so basically, yeah, sure. At the moment, we do have restrictions. We're not the most restrictive, but by no means are we the most liberal in our foreign investment policy. What is interesting, and that's why I find this debate particularly interesting around the Chinese investment and cubby, is that the attitudes towards foreign investment in our businesses and our communities really depend on what asset we're talking about. So in this case, a recent survey asked people on the street what their thoughts were towards foreign investment in the mining sector. 48% thought it was absolutely good. If you went in agriculture, it was only 36% thought it was all good. If you went down, conversely, to those who thought it was absolutely bad, 26% thought it was absolutely bad in mining, 41% thought it was absolutely bad in agriculture. Then if you went down to where that foreign investment comes from, Chinese state-owned enterprises, 23% thought it was a good idea. If you went down to who disapproved, 60% thought Chinese sovereign wealth funds in agriculture was a bad idea. But yeah, if you went down to US corporates, 38% thought it was a good idea. So you go from 23% who don't like the Chinese investing, but quite happy to have the US investing. So we do have a little bit of, I don't call it xenophobic, I call it sinophobic behaviour within that, their views towards foreign investment. If you then looked at the, go back again there. Well, we understand foreign investment in Australian agriculture has come and it's gone. Now, did it come and go because it failed, or simply because management changed, or simply because investors changed, or indeed they reached their targeted return on capital and they left? And I think the difference between a family operator is that they see it as intergenerational. A foreign investor or a corporate investor sees it as an opportunity to make some money and get out again. So I think therein lies the difference. The outcomes are still about wealth creation. It's just a matter of whether it's intergenerational. If you look at over the years, we had the Vesti family. Now they were totally sold out by 1992. Their legacy is that they actually developed the export of meat out of Australia through their chilled and frozen containers. You know, if it wasn't for that market, you'd say someone else might have come in and done it, but someone has to be in there in that first start and do the heavy lifting. Gregory Hadjialeftathiadis sold out his Alice Springs Pastoral Company in 2009. His legacy was that he actually was the first one in on any large scale to do the organic beef production in central Queensland. My company, the John Swire and Companies, sold out just recently in the last month, the last of it, but 2010 to 2014. They'd been in it 20 odd years. But coming back into the market now, we have the Westchester Group, been active buyers since 2008, Terra Firma with 90% of CPC, 2009, Hassard, as we said, have been active buyers since 2010, and Shandong Ru with Cubby Station in 2012. The point is that foreign investment has always been a critical part of Australian agriculture. It's come in and it's gone out, and it will continue to come in and go out. If you looked at the 10-year view, again from the only state that has stats on this, and that's Queensland, over that 10-year period nearly 10-year period from 2000 to 2009, the actual amount of foreign investment didn't change. It was only when they did the CPC transaction that it changed dramatically, and that's only because CPC was such a large percentage of the state on an area basis. So back to that point of we need reliable stats so we can have a debate about it rather than having a lot of rhetoric about it. If it wasn't for that CPC transaction, then foreign investment in Queensland wouldn't have changed over that 10-year period. Keep forgetting to do that graph. Sorry, that was that. I'll take a little case study of Oscott, and the Oscott, the family, the Boswell family, are very anti publicity. So I've just been very cautious in using this off their website. So I'm sure they won't mind it. Oscott is one of Australia's largest cotton growers, ginners, and marketers. It's 100% foreign owned by the G.J. Boswell out of the family out of the US, King, California. They commenced growing cotton in the Namoy Valley in 1963. It was an absolute disaster. They produced 697 bales off 1,628 hectares. Now, if it was an Australian family, they probably would have walked away and said cotton can't be grown in Australia. Because of who they were and what they did in the US, they actually said, well, let's bring in people who can develop our irrigation systems. Let's bring in the best agronomists we have. And so from that to where they are now, 51 years later, they've really assisted that cotton industry grow from that very small figure of 4,000 acres to where it is today with about $2 billion of farm gate activity. Oscott continues to be the leader, or one of the leaders within that industry, within the R&D sector. They continue to be one of the best corporate citizens in the Australian cotton industry. To me, here's a good example of a foreign entity that has not only participated in agriculture but has actually created an industry. Another case study, if you talk about where to from here for foreign investment, Australian dairy industry. In Tasmania, they have a program called Fill the Factories. Tasmanian dairy processors at the moment are operating at about 70% of capacity. So in order to fill those factories, to get efficiencies into that industry, we need about 40% growth in milk production, which is an additional 350 million litres of milk per annum. So it requires around 65,000 cows to do that. If you looked at that at around that 11,000 per cow area, we're talking about an extra $750 million that needs to go into the Tasmania alone just to fill the factories. We're not talking about going to the next level and creating a New Zealand type model. We're actually just talking about filling the capacity that's there is going to require $750 million. So where's that capital likely to come from? The average Tasmanian dairy farm has a debt of 1.82 million. This is on ABARE's latest stats. The average equity for those farmers is 60%. The average debt per cow is about $5,000. An expansion by 65,000 cows just to fill those factories cannot possibly be debt financed by the industry as it exists at the moment. So that means, where's that capital going to come from? It's either going to be ultra high net worth investors from the cities, from Australian institutional investors could be another one, but they are very difficult to attract capital from. We've seen a history of them over the years. National Mutual have come and gone in agriculture. Commonwealth Funds Management exited. AMP, which was incredibly well managed, was exited after 39 years. The interesting part of that was that it was it provided, wasn't a failure in the corporate space, a 24% internal rate of return over the 39 years that AMP owned Stanbroke. But where are we now? Because they've exited. We've got Sustainable Ag Fund with about $145 million of domestic institutional investors. We've got Warrakirri with around $300 million. Future Fund, we're going to invest within Prime Ag, put some money up. Obviously that fell apart. I'm not aware of too many others. As Peter said, we've got about $1.6, $1.8 trillion in superannuation funds within Australia, and we've got about $500 million of that actually in agriculture. We just can't seem to get the capital to be attracted in there. So if we need $750 million to go into Tasmania alone in the next 4 or 5 years, and we've actually got about $500 million total invested in Australian agriculture from the domestic instos, I really don't see any other potential to grow this. It's not going to come from the balance sheets of the farmers because they're stretched. The Australian institutional investors are very reluctant to invest in ag, and the government would not or should not invest in agriculture other than in infrastructure. So the question is, where will this capital come from to grow the Australian dairy sector in Tasmania, as well as, and you can take that example across any other sector you like, the only chance we've got of actually achieving the targets we want in those industries is through foreign investment. Thank you.
Thank you, John. Do we have any questions for John? Jim.
Look, I think there's a number of reasons, and it's probably different reasons for different investments. But the great challenge in corporate ag is to create more value out of your scale than you destroy through your overheads. And I think over the past, and probably some examples now which I won't name, but you could look at some of those entities that haven't achieved that. They've almost had diseconomies of scale, and then they're thrown in a whole corporate overheads with 30-odd people sitting in a Pitt Street address or a Queen Street address. And so I think we've got to get that model right. We've got to understand that this can't just be about clipping the ticket on the way through. There's got to actually be value handed back to the investors. So that, I think the model's got to be right. The other one is that from the institutional investor's point of view, I always go back and say to anyone I'm talking to about it is that you need to understand that in 80% of your profit will be made in 3 years out of 10. So if you take a short-term view, take a 5-year view or even a 7-year view, then you potentially miss out on those 3 years when you have it. It's not an industry that gives you a steady 4 or 5% return every year. But if you can get 3 of those years that give you 80% and the other 7 years are either losing a bit, making a bit, or making the other 20%, you need to understand that. And the investors, particularly domestic instos, say, yeah, we understand that and we understand the volatility around it, but can you do a quarterly valuation for us? It's good for Danny that we do quarterly valuations, but it's inconsistent with this longer term view that they need to take because of the short term need that they have to report unit prices. And from their point of view, they say, well, it's fine to take a longer term view, but every year we will publish our fund returns versus the other 114 fund managers in Australia. And if we've taken a too long a position in agriculture and we've had a bad year, everyone pulls money out of our fund and puts it into someone else's fund. So it almost needs to be, one of the good things we have in Australian super industry is the flexibility. You can swap fund manager, you can do anything. You'd almost say one of the bad things we have in the Australian super industry is that you can swap so easily because people just look at those numbers and pull that money out, and no one wants to be the one who gets the bad return. So it's always going to be a small return. It's always going to be a small part of the overall investment, but we just need to make sure that investors and both the funds and you and I need to understand that that's a volatile return, but longer term it will give the returns out of it. That answers it. Yeah, if I talk about thin capitalisation for more than about 20 seconds, I'm going to be out of my depth, so don't hold me to it, Rob. But yeah, look, you're right, because if you have a highly geared agricultural investment that's land rich, you simply can't gear it too much because you're not going to have the operating returns out of it to fund it to 60, 80% gearing. And the only way you can then do it is capitalise those losses and how you fund those losses going forward on your balance sheet. And ultimately, if you take your capital gain and then you wipe those losses off, but because you can't take capital losses off against income losses, so they become trapped. Look, is it an issue? Look, I don't think it's an issue. It's not an agricultural specific investment piece of legislation. It's around foreign investment in any industry, thin capitalisation, and it's not really a matter of NFF policy or Barnaby Joyce's whim. It's actually at the taxation level that requires that legislation to be enforced. Probably doesn't really answer what you're saying, but. Yeah, so in a trust structure which Sustainable Ag Fund operates in, we book our unit price. So effectively, what we report back to our investors is the unit price, which includes the actual cash, the market valuation of livestock, plant and equipment, and then a mark to market on the land valuation. So we're able to do it through that. If you do it through a company structure, obviously you can't at this stage book those capital gains through. Which is why in a publicly listed entity it's just too difficult to work. Good side is you can't actually, when it goes back against you, you don't have to take the hit again, which is in the case of AACO. But certainly in a trust structure you can do it, but in a company structure, my understanding is that you still can't. Yeah. Yeah. No, agree, Lockie, thanks. Yeah, look, 136 farmers, I always say we've just got to stop talking about 136,000 farmers in Australia. On the ABS data, which Neil Clark works with, 68% of farmers turn over less than 200,000 a year. Now, if you're turning over less than 200,000 a year, you're running a hobby farm or you're working off farm, and there's no way you can be making a living out of turning over less than 200,000. So in the numbers, we should almost be trying to work on what the terminology would be, but professional farmers versus those who make a living or somewhere else and enjoy what they do. It's, I think McKillop put it best. He said it's like saying the average earning from golfers is $120 a year, because most people are doing it at an amateur level. It's only the professionals that are making all the money. So so I think we've got to get out of this thought of farmers. There's professional end of the farmers, and I'd say even probably half a million probably should be the cut-off, but you debate that. So I think if we look at that professional end, you're right. If you're AACO or Prime Ag, it's easy to sit there because it's reported in the Fin Review and to say they didn't do this and they didn't do that. But you've got Bill Smith down the road who probably wouldn't do any better job, but he never hits the paper. Or only thing you hear is a bit of pub talk about it. So it is the quality of management, and that's one of the most difficult things we face in corporate, is actually getting hold of good management. Despite the people saying that there's no money in agriculture, our managers, are certainly well and truly earning their six figures and some. You've got agronomists that if you can attract agronomists for 5 years out for less than 150, you've done well. There is money to be made for those salaries. We have to pay good salaries. At the end of the day, it's unlike probably a lot of other industries where rent and wages constitute the majority of the expenses. Typically ours run at around 20% of our total cost. So whether we have to pay a little bit extra to get the best person is not really a big issue to us. It's just a matter of how we get it. And so one of the other industries boards that I'm involved in is called the Primary Industries Education Foundation. What we're trying to do there is get agriculture into the curriculum from K to 12. Firstly, because we want that social licence, we want people to understand where food and fibre comes from, but secondly, and probably almost more importantly, is we want people to actually consider it as a career. We want people to come to Marcus Oldham or UNE or Melbourne Uni so that they can actually, so we have a greater pool of talent to choose from when we're looking for those managers to run these major assets. If I run out on thin capitalisation in 20 seconds, we're going to run out of intensive agriculture in about 5. Probably the one I've had the most to do with, or really the only thing to do with, has been the feedlot development. The feedlot development was essentially developed out of Japanese money in the 70s and 80s. It was nearly every major feedlot in Australia was owned by them. They bought the demand side at the other end, and with that came a whole new industry that really grew out of that foreign investment. Now, whether you'll see the same within aquaculture, I suspect you're right, but then is the family farmer going to take that risk and put in a $10 million aquaculture? Probably not at any scale. Is the domestic institutional investors going to do that? Well, they're risk adverse anyway, so to go into something that's as unproven as aquaculture or any similar production system is probably unlikely. So again, it's probably going to end up being tied to where the demand comes from. And if the demand for, say, seafood is coming out of Asia, it's hard to see that investment won't come out of Asia. Now, whether that, someone once said to me, wise men build big houses for fools to live in. Sorry, other way around, I think it was. I think whether you have an industry that people will invest heavily in, it falls over and someone else picks it up and makes an industry out of it, then that's probably, is that, it may not be good for them, but it may be good for Australia investment. So Oh, good, great, okay. I think it's right, and I suppose another group I'm involved with is the corporate ag group, which is 8 or 9 of the larger sort of corporate end players. And one of the things that we're actually in early stage discussion with Simon on is developing a training program specifically catered towards large corporate managers. And not to say that can't involve family-owned operators, but we're literally looking to target it where succession issue is not so much of a problem, but reporting OHS, understanding the business cycle is important. So it is a void at the moment that we have. We don't have a lot of training within that sector specifically catered towards the corporate sector, but hopefully over the next year or so we'll work towards solving that.